Yes, guys and girls, welcome back to another BMO video. Today we're going to be looking at reaction function of the market. It's going to be a relatively quick video. It's not a complicated thought process. It's actually really easy and simple. And we're going to go over that today. You've probably heard the term through the weekly videos that we do and the breakdowns. We talk about the reaction function. How does the dollar react to this bits of data? That will tell us a lot of how the thought process is. And it's actually pretty simple. And you can apply this instantly. Firstly, the markets is always giving out clues into what they care about and what they see as new or what they see as old news. So, of course, we're going to look at direction of data surprises. That's what we mean by new and old news. Of course, that'll be the next video. This is known as the reaction function, and it's a lot more powerful than you may think. If the markets react to certain bits of data and not others, then that'll tell you what the market cares more about. And as a result, you should be caring about that as well. Remember, if the market cares about it, they're going to react to it. So if you're seeing, current accounts come in good for the currency, for example, and the currency or a country and the currency doesn't react, but you start buying the currency because of that reason, you're going to get battered quite a lot by doing that. So please don't jump into trades just because data surprises or reaction function has happened. It's important to consider what the market cares about. That's really important. And if the market reacts to certain bits of data, then that will tell you what the market cares about, and as a result, you should be caring. Okay, comes with that. It's important to note that waiting for a couple of hours after the market reaction is a better gauge to see if it's seen as good or bad or neutral for the currency. Generally, you've probably heard that saying the first move is always wrong. So you might have seen it where, let's say, inflation comes in slightly hotter, that pumps dollar, let's say, and then the dollar sells off. So it's important just to see why did that happen. So maybe the market's bought up because the headline inflation came in higher, for example. They're buying it because they saw the headline. So the number you see on Forex Factor or Trading Economics, but they may have looked at the underlying data and actually saw, there's a big component here that's sold off. Let's sell that because now that general flow of inflation is likely to turn lower, for example. Or the markets care more about services inflation in the UK, and they're seeing that dramatically fall, but inflation came in hotter because of an upside surprise in, let's say, used cars. Well, markets are a bit more caring about services. They're going to sell that currency. So pump because of headline, sold off because of what happens with the service, for example. So yeah, I always generally just wait for a couple of hours after just to see, because it's generally volatile around big events. It's just best to wait and see how does that tell you. And if the markets have pumped it really aggressively and held that, then clearly the market's like, this is really, really good for the currency or good for the theme, shall we say. Upside surprises. So if the market doesn't expect the figure, obviously they will react. This seems like basic thought process, but it tells you a lot about the process of how the market is thinking. If there isn't a large reaction to an upside surprise in the data, then this tells us that they simply don't care or isn't news or new news in their eyes. I.e., if inflation comes out hotter than consensus, there may be large reaction due to them already expecting it from some survey data we have seen recently. So, for example, let's say we had prices data in services PMIs come in really negative. The markets, obviously, PMIs are forward-looking indicators, so it tells you what could be the event or the environment sort of ahead. And then we see inflation come in weaker. Well, the markets may react slightly to it, but not as much as you may be expecting, because maybe the market sold off the currency in the run-up to that meeting, so buying into that rumor, selling the fact. So how do you use this in your trading? The reaction function tells us if something is new in the eyes of the market. This will add to the narrative that maybe rates need to go higher, potentially supporting the currency in the weeks ahead, for example. One thing to note is, although there may have been some upside surprise in the data, the currency could actually weaken. This could mean a couple of things. One, I kind of briefly touched up on that, but a specific underlying data was weak, like prices in the PMI data. Lower prices would support the idea that there could be less inflation down the line, which may put downward pressure on the currency. Two, a higher print in inflation could mean more rates. Well, if the economy is weak already, higher rates would only harm the economy and as a result, the currency. So you have to use your brain. For example, like here, where the markets were expecting to hold, they actually hiked, but the currency weakened off. So it's important to understand the reasonings for that. Always really important, please. So you can kind of see a live example where in this one here at the bottom, the number 2, naturally, if a big upside surprise happened and is supportive for the currency, then yes, that's going to be pretty good. But in this example, the euro area in September is really, really weak anyway, and the growth is terrible, and not great, shall we say. Well, a hike is only going to harm it even further and pull growth lower. So why are we going to be buying the currency when there's more risks tilted to the downside? So of course, euro is obviously weaker due to downgrades in the growth. And of course, BOE and the pound. So we understand in September or 2021 to 2022, the pound weakened in that environment, right? But the data was supportive to the upside. But it's important to understand, why did the pound weaken? And looking at that reaction function tells you everything. So it tells you, okay, there may have been upside surprises in, let's say, inflation data. Why did the pound weaken off? Well, there was growth wasn't as good when compared to others, people or other countries. The Bank of England was very, very, very hesitant. They didn't want to hike. They were jawboning, basically stating, yeah, we've got a bit of hikes to come. And then they don't hike at the meeting. So they're trying to just jawbone the currency. So that's really, really important to think about, is not necessarily just because it's upside surprise that you now need to buy the currency. It's how does this upside surprise do for the theme? And okay, does the underlying data as well? So for example, if inflation rises, does the growth data support that view that inflation has risen for good reason? And that's really important, because naturally, if inflation rises, you now are likely to think that the central bank is going to hike again, or at least markets will price in that probability. Well, if growth is weak, then that's not going to do anything for the currency in a higher inflation print. Now, of course, think about it now in this environment where higher inflationary data in the euro area probably points out, maybe actually weakens the currency, because if high inflation comes out, maybe that means the ECB might need to hike again. Well, if the euro area is weak, the currency will weaken off, right? It's not going to strengthen when there's a stagflationary environment. And of course, to the flip side is obviously downside surprises. So similar to the upside surprises, downside surprises will weaken the currency if it supports the theme of the market at the moment. For example, does the weaker employment support the idea for earlier cuts? Logically, this is obviously correct. It's always important to look at the underlying data to see why the data print came in weaker than consensus. Watching the reaction of the market to a downside surprise tells us how bad they see the print, so important to watch that. And remember not to think like a robot. A downside surprise in some instances can actually strengthen the currency. In this example here, where we had PCE come in really weak, on the same day it pumped and it moved higher. I think this is the 4-hour chart. So obviously that's 12, 1, 2, 3, 4. So that's just as an example there. So you can see core PCE came in weaker. Generally, that would mean, okay, that's the Fed's preferred mandate. Maybe the markets may price in more cuts or a likelihood of a cut. Currency actually strengthened because the underlying data still showed inflationary pressures. So just to add on to that narrative there, a downside surprise in PMI should weaken the currency, but may have underlying data that supports the currency in the near term. So for example, services PMI comes in low on the headline figure. So let's say it comes in at 48. But the underlying employment rate rose to expansion territory above 50, suggesting a potential recovery in the labor market. And the markets may actually react to that. That's important. So if you're thinking ever, data's coming really strong, but the currency weakened off. Obviously, there's always reasons for that, right? And that's because the underlying data, and this is why I always emphasize in the breakdowns, you have to always look at the underlying data. Really, really important here. So the reaction function is really easy, right? All you're doing is looking at the data. Okay, cool. Inflation comes in hotter. How does the dollar react? Really easy, reaction function. It's not obviously difficult. And we will have to consider that. For example, you might see, I don't know, a kind of real wild sort of thought process. But let's say inflation comes in weaker for the euro area. That may support the euro or the euro going high and going forward, for example. Obviously, we're not seeing that, but at some stage that might happen. And you might think, that's really weird. Well, not really, because lower inflation now means, growth or growth is likely to start bottoming, because if there's less inflation, there's less price pressures now, and it's a bit easier for the growth to pick back up again. Markets may price that in ahead of time, pricing it in, of course, buying the rumor. This is obviously a wild guess. It couldn't happen, but I'm just saying, if you're ever confused about why something has happened, this is the thought process you should have. And always, always, always look at the underlying data here. And of course, too, think about so much negativity will be in the currency's price. Obviously, weak price action. That any more slightly weaker than consensus prints might not move the markets, as it's not new news that the economy is weak already. Look at Europe, for example. What we mean by that is German industrial production comes in slightly weaker than consensus. You might think, downside surprise, the currency weakens off, but not really. If the markets are so weak, the euro anyway, it's not exactly new, is it? Because they would have priced in the weaker euro because of that reasons. We would have seen that reasons in the months before that, and the markets would have priced it in already. So it's important to think: does this come out consensus, or is it coming out upside surprise, downside surprise? 1, 2. So obviously that's for the headline figures. 2, does the data support that narrative? Sometimes you see in this example here where core PC came in weaker, you might think that weakens the DXY. They actually strengthened it. Okay, that's a bit weird. And they might have also been looking at personal spending, for example, contracting slightly or a bit less than consensus. We have to wait and see, right? But these are just examples of what you should be doing. And then 2, if there's so much positivity in the price already, then a new set of data that's positive isn't exactly new, is it? In the eyes of the market. But this is why the reaction function tells us that if it's new to them, because obviously we aren't the people who move the markets, right? So we just have to work with what we see on the chart. So the reaction of the currency tells us quite a lot, doesn't it? And it's relatively easy. All you do is just look at, for example, let's say this is today. Core PC came in weaker. Okay, we're seeing DXY strengthen. Okay, that's a bit weird. Why is that happening? Okay, let me look at the underlying data. You can either click this and then latest release, and then it'll bring you to the website, or go into Bloomberg and just see what the other analysts say. And okay, that's the reason why. Obviously, eventually you want to get into a stage where you look at the underlying data by clicking this, and then that gives you a gauge before the what the other analysts have said on Bloomberg or Reuters, whatever website you want to be using. But obviously that will come with time, and the more you do it, the easier it becomes, right? And remember, always think, does this data print support the theme/narrative of the market? Really, really important. Because again, if you're looking at other bits of data the market doesn't care about, and you're buying and you're thinking, oh, this is really good for the currency, maybe we want to be long, but the other data that the market cares about is actually printing lower and downside surprise, you're going to get wrong-footed, right? And then you're going to start doubting yourself, doubting your skill, and then obviously that becomes a bit more of a bigger issue, because now your mindset is pretty effed, basically. So yeah, hopefully this makes us quite some sense. Again, it's something you just have to continue to do. It will just become easy with time. You just have to just do it. And let's say, ECB's hiked. Okay, well, that instantly you'd think, okay, that's not good for the currency because growth is weak anyway. So that's going to hurt the currency. Okay, great. What's the reason they hiked? Okay, let's have a look. Maybe inflation was slightly stickier, for example. Okay, what's the statement saying? Click on the statement. They've actually downgraded growth. That's not good. And that's why the currency weakened when they hiked, right? So hopefully this video makes sense. All you got to do is just consider, obviously, everything we've spoken about today, but just, going forward, this is what you should be doing now, and just get into the mode of it. It'll become a lot easier, right? The more you do it, the easier it becomes generally. So that's it for today's video. I will see you in the next one. Take care.